You have to run a company as if it could go public.
The number of publicly traded companies in the US has been cut in half from about 8,000 to under 4,000. More companies are actually going private each year.
You go public, you spend all that money, it's hard to get a return. Running a good company is also criteria to having an exit at all. And so I think you're doing all those things as a CFO. And if you're not, just because you don't think you're going public, I think you're making a mistake. And I hear about companies that have 100 million of ARR with 10 people. If you go ask an investor, well, how do our KPIs look? They're like, well, you don't look as good as this company that's got 100 million ARR with 10 people.
I got to drop my stomach from that.
I pride myself on running the operations as if we could go public one day. But there's a lot of things I won't invest in. Like, by the way, only CFOs would laugh at a joke like that too.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. Back by popular demand is Chad Gold for round 2. CFO at FullStory and one of the most seasoned operators in growth stage SaaS. Before this, Chad held the CFO seat at G2, SalesLoft, and Rubicon, giving him a front row view of how capital markets, pricing models, and finance strategy have evolved over the last decade. In this episode, we kick off with a look at the current macro environment. Chad unpacks why companies are staying private longer and how the IPO path has shifted, and what the rise of private credit means for CFOs at building their capital stacks today. The playbook is changing, and Chad's been rewriting it in real time. We also get into one of his specialties, pricing models and sales incentives. From seats to usage to blended models, Chad explains how each structure affects comp plans, rep behavior, and long-term revenue quality. He's seen firsthand how the wrong incentive can quietly derail a great product and how to fix it before it snowballs. And finally, we talk origins. Chad started his career not in tech, but at Home Depot. He shares the operational lessons he brought with him from retail and why some of the best instincts in tech have nothing to do with software. All this and much, much more after a short word from our sponsors. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury's making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales with your ambition. Visit Mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit tipalti.com/runthenumbers. Tipalti.com/runthenumbers. Tipalti, serious AP for serious business. Chad, welcome back to the Run the Numbers podcast.
Well, CJ, thanks so much for having me. You know, I'm a big fan.
You just started an exciting new chapter at FullStory. Can you give us the TLDR? What's hip these days?
Yeah, I mean, well, one, it's super great to be back at an Atlanta-based tech company. You know, and I was lucky. I've known Scott Voigt, our CEO, for probably 6 years. I met him back when I was at SalesLoft. You know, kind of advised him on certain things along the way, and an opportunity opened up for us to work together. And, you know, for me, I think what I was most excited about FullStory, it's really three big things. You know, one is if you take a step back, technology like FullStory, sort of a behavioral data platform, you know, our ability to understand the entire digital experience. And I know you'd referenced you were a customer, right? But of any web-based property, you know, whether it's an e-commerce website, web-based software, it's unmatched in terms of all the data we can capture. So that I got excited about that. When you then couple that with AI and, you know, you start to think about it, the companies that are going to really win in the future are the ones that have the capabilities to capture the most robust and the highest quality data sets. And I mean, FullStory sits squarely in that around how people literally engage with the internet, with software. And then I think the last one that I was really excited about was, you know, for FullStory, I think you're very similar to me. I get really excited about the product roadmap, and I spent a lot of time. We had just hired a new chief product officer. She's I think she's about a year in now. And when she walked me through her vision in terms of just applying the same digital technology, not just for customers, but you can apply it for your employees, you know, in terms of understanding, you know, CJ, if you had a accounts receivable clerk and you wanted to understand what their workflow looked like, you could actually use FullStory to record that entire experience. What systems were they in? What did they have to pivot and switch to? And then you could identify opportunities to then automate the process or standardize it, not so you can get rid of people, but you could make them reviewers instead of doers and things like that.
That's incredible. I didn't know that there was an internal use case. Like my experience with FullStory when we were at PartsTech and I was CFO, I inherited the data and analytics team. So I got like thrown right into the fire of like trying to figure out how to build data pipelines. And me and you were saying before, Sarah Riley, previous guest of the podcast, DBT Labs, we're using DBT in conjunction with Snowflake and then FullStory. And so those were three of the bigger spends we had at the company. But it was so critical because we were running a marketplace that was driven by daily user activity. And we needed to know what people were adding to their carts and where they were falling out. And like before using that, it was kind of like we had a hypothesis of what was happening, but like being able to link, and we talk about this in the show a lot, like the user data to the product data to the financial data, it allows you to go further upstream rather than just like waiting for like revenue to show up.
That's right. And I think, you know, what people don't realize is in the old world, you know, and even some of the competitors of FullStory, you know, their view on how to capture things is instrumentation. So, hey, you tell me what you want to measure and I'll measure that button, that click. FullStory, we just capture it all. And sometimes to your point, it's great if you have a hypothesis. One, what if your hypothesis is wrong?
It was a couple of times, like really wrong.
Yeah, and I mean, most people, that's why they call it a hypothesis, right?
Yeah.
And then number two, it's like, what if you don't know? And so that's where FullStory and the really the magic of, you know, full capture and auto capture starts to really be a big unlock for companies. And I think, you know, one of the things that I've seen, and I think I underappreciated this, when I was at SalesLoft, we were pretty heavily penetrated in tech. You know, everybody says how software companies adopt software. It's just a known thing. And I think that we grew really fast on that. And then we diversified at SalesLoft. Coming to FullStory, and seeing the use cases that we have in retail, in food and beverage, in travel and hospitality, in gaming. I mean, all of a sudden there's like all these applications, and they're not like these big stretch things. Well, oh, the software could do that. It's like, we really know the use cases already for it.
That's really neat. If you think about like where you started your career as a CFO and the amount of data you had like that you could reach for and make decisions based on to like now, where are we on that spectrum?
Oh man. I mean, probably if I go back to when I first became a CFO, a lot of it was waiting for the month to close so you could make decisions based on, what you found. And, now it's like you're able to your point, you're seeing stuff daily so that you can make real-time decisions. And I think that's actually the way it has to be now. I mean, so if I was at a 2 when I first started, I think probably in the 7 or 8 range now. You can always get better. But, I think the ability to understand pockets of where there's opportunity to grow the business. You've always said this on the podcast, like the best CFOs, they make the news. They want to really drive performance in the business, and you got to have the data to do that. I think that's the expectation of the modern CFO. It's not, hey, tell me what my budget is and how I did. Like, that's fine, but like that's like a 2% of the job at this point.
Yeah. And like the planning models, the annual planning models that I built when I first started my career, because I came up in the FP&A world, they were all these deterministic models that were based off of just the P&L, had very little user activity in it. And now like you're building full marketing pipelines and doing it based on, like we said before, not just financial data, but like the inputs are almost closer to building like an analytics BI forecasting model than it is like a financial model.
Finance is just the expression of everything that happens in the business and numbers. And I think if you have the ability to do what you described, which is take what's the data that your operators are using every day, whether that's customer data, user data, churn data, all those things, and connect that to the financial outcomes. And really, you have to build it's almost like a driver-based operating KPIs that lead to the financial KPIs, because then you could start to talk to your CRO, not in terms of like, hey, I want my GAAP revenue to be some number. That's great. He doesn't know how he's going to get there. But if you say, hey, I need bookings in this segment to grow this much in the next 3 years, he starts to say, okay, well, now I can get my head around that.
And also being able to look at customers on a cohorted basis based on like when they entered the company or like their qualities. Me and you were jamming out before the pod started about like just being able to say, how many customers do I have $50,000 or over? Like that used to be a total nightmare to try and go and pull.
Right. Or, and it's like size of customer, industry becomes really important. You got to have a tie-in with marketing and sales. Are you selling to the right customers? I have this phrase I use, which is, if you think about revenue quality, you're driving up market, it's diversified, and it's durable. And you can measure all 3 of those things. Up market, what percentage of my ARR is in an enterprise plus? Is it diversified? Back to my software, non-software comment, what's my industry penetration and how does that look? Do I have enough spots that I can go to if the macro changes? And then the third one, durability, is like, what percentage of my contracts are multi-year plus? And you can measure those things and you can give people targets to execute on. And they're like, oh, that makes sense. Like, of course, that's why we do it. But if you don't have the data, it's very hard to do it.
That was beautiful. That's awesome. Chad, I've been looking for a partner to jam out on like the kind of state of the private markets. And you've held CFO seats at several like very scale stage companies, Rubicon, SalesLoft, G2, now FullStory. And you've seen like this later stage growth from the inside. What's your take on the current capital markets environment? Like, are we entering a new era where companies are simply staying private longer by design?
I hate to give you the yes and no answer. I think it's a little bit of yes and no. I think yes by design, because I think there's more private capital than there ever was before. So there's more optionality. Secondary markets are bigger for good companies. Private equity is much bigger. Like, there's a lot of ways that you can monetize your business or get outcomes for your investors and your employees that's not going public. But the reason I say yes and no is the no side is I think a lot of companies are staying private longer because they have to. Yeah, they've had to get profitable and they're trying to grow. And then the at least for a long time, we haven't had that many software IPOs in the last 3 years. The yardstick he used to say was once you got above 100 to 150 million in ARR, that started to look like a great public company. That's now 250 million plus. Law of large numbers, getting to 250 million, especially where everybody's been running through the last 3 years of a little bit of an economic trough. It's challenging. So I think it's kept a lot of companies private longer. It feels like private capital money moves in pools. And what I mean by that is when you became a CFO, when I was the CFO at SalesLoft, there was times where it was like high growth, sales and marketing tech was big, a few of those areas, and money was kind of pumping into those areas. Now that's AI. And so if you're an AI company, yeah, you can stay private for a really long time. Now, what I don't know, and I think what's too early to tell, is you and I know that raising money is not an outcome. And so when I see these articles about so-and-so company with 10 million of ARR raising at $1 billion, I know people celebrate that. And I think that's a great thing, but you have to return the money to your investors and give them a return on $1 billion valuation. So you just have to be smart at how you think about that, for sure.
Hey, thanks for listening. We'll be right back after a word from our sponsors. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. And so I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com. aleph.com/run. Tell them CJ sent you. Morgan Stanley recently said NetSuite is under the threat of disruption. That's right, NetSuite, the you never get fired for buying it software. So what's the threat? The answer, Rillet. Rillet is the AI native ERP modern finance teams are switching to because it's faster, simpler, and 100% built for how teams operate today. It doesn't take 12 months to implement. It doesn't feel like filing taxes to use, and your accounting team will actually love it. PostScript closes the books in only 3 days. Windsurf, bet you heard of them. They run finance with just 2 people. And Rillet is backed by Sequoia Capital. Yes, that's Sequoia. Unicorns like PostScript and Windsurf and hundreds of other companies have made the switch, and they're closing books in record time. If I were running a finance team today, I wouldn't default to legacy. I'd look at what's coming next, and Rillet is here. You don't want to be that guy at cocktail parties complaining about how bad his ERP is. Wait, am I the only guy who talks about ERPs around a keg? See how fast your team can move. Book a demo at rillet.com/metrics. That's RILLET.com/metrics. RILLET.com/metrics. This is a paid ad by Fidelity Private Shares. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com. Mention mostly metrics and get 20% off. Can you say more about capital moving in pools? Because I totally agree with you. I don't want to call it flavor of the week, but it does seem like, I remember cybersecurity was like the hottest thing on earth for a while.
Yeah, it was like sales and marketing tech, then it was cybersecurity, data, like we talked about DBT a little bit, data pipeline, data infrastructure like Snowflake became big. And then, now it's AI. And I think that term gets thrown around a lot. I think there's a lot of incredible companies. And what I even see now with AI that's very interesting is there's companies that are leveraging AI for their customers, and that's incredible. But what's even more interesting is there's companies that are also just leveraging AI to build a really, really efficient company. And I'm sure you hear these rumors all the time. I mean, I hear about companies that have 100 million of ARR with 10 people. I don't know if that's true. I mean, I personally met somebody who's done that, but if you go ask an investor if you're like, well, how do our KPIs look? They're like, well, you don't look as good as this company that's got 100 billion ARR with 10 people. So I think that the AI wave is where everybody is investing now. And the challenge with that is like, it does drive up the valuations in the space. And I think, look, investors are smart. I mean, I think they want to go where they view cutting edge technology, where they view the market. And I think AI has obviously been the most disruptive technology that's been released, certainly in my time of work.
This stat I read recently, it blew my mind. It said that the number of publicly traded companies in the US has been cut in half from about 8,000 to under 4,000. And that's in 3 decades. And now we're seeing names like Olo, PagerDuty, a couple others. They're all eyeing a return to the private markets. So now we're in this like mode where more companies are actually going private each year than there are companies going public. So I'm like starting to question if like the traditional benefits of being public are eroding a bit.
I think it's a great point. I've heard a similar stat. I think back to your comment, the access to capital, having private equity firms that are willing to do very large transactions really changes the dynamic. And look, I mean, if you go all the way back to the early 2000s when SOX and all these things got rolled out, I certainly get you've got to have controls and protect your investors and do the right things. But there's such an over and above that goes at being a public company. Every company I've worked for, I pride myself on running the operations as if we could go public one day. But there's a lot of things I won't invest in, like IR, like the incremental audit costs, the incremental law costs. I mean, there's millions of dollars. And I think it's hard right now. You go public, you spend all that money. And right now it's like, it's hard to get a return.
It is. And the stat that blew my mind the most within that article is that I think it was the average cost for printing, like for paper when you go public, is like 110 grand.
And who reads a paper?
I don't know.
But you're right. We are going to have to figure something out, because if everything is cost and benefit. And if you're not getting the benefits being public, but you're spending all the costs and putting all the tax on people, it's not going to work in the long run.
Yeah.
And yet, and I think that those same investors that drove liquidity in the public markets have a lot of vehicles now to invest in the private markets, whether that's via private equity firms, whether that's via venture capital firms. I mean, individuals who wanted to deploy capital or get exposure in the stock market can kind of do that in a flavor of private now too.
I'm so glad you brought that up, because like this isn't an investing show by any means. My lawyers require me to say that. But like if you think about getting access to the best companies, like if you wanted to invest in Amazon 20 years ago and let it compound, you could. But like Thrive comes in and throws another $1 billion at Stripe or whoever, and they're like, why don't you just stay private longer? It's almost like the best assets at some point are almost like sequestered off to just these private investors. So then you say, well, if I want to get exposure to that as either an employee, I guess you could work there, but like as just CJ, how do you do that? Is it almost like those assets you can't touch?
It starts to become like a who you know, and you're, people who are involved in technology tend to get access to some of those deals, get exposure to them more than people that don't. Certainly keeps people out of it because there's certain minimum capital requirements and things that go into investing and things like that. The other thing you can do now, I think, which is interesting, is, there's all these secondary markets. Now, you got to know what you're buying, but you could technically go and acquire common stock in a lot of different companies if you really wanted to. I think the thing that investors, and again, to your point, this is not an investing show, but you just have to know, like, the reason why public markets work is because it's liquid.
Yep.
And you got to be really thoughtful about what capital is getting deployed in the private markets, because you have no idea when that stuff's going to become liquid.
I saw this one, it was like a map of like who was holding SpaceX shares, and it was like an SPV investing in an SPV investing in SPV. So you were like 4 layers away from the actual cap table. So while you think this is an amazing asset and it is a generational company, like it demonstrates the lengths people are going to get into like a SpaceX.
That's exactly right. Yep.
Do you think staying private longer shifts the way that CFOs like you and others contemplate like building your finance team for the long run? Like you mentioned IR, but like systems, people, like does that change at all? Or are you always just, if we had to go tomorrow, we had to go?
I think the answer is you have to put in the people and the systems that you would want if you went public. You have to run a company as if it could go public. That does not mean, though, that you should go invest over and above in things that aren't necessary today. And I know I've done this for a little while, but like I can handle IR for FullStory right now. It's not a big lift. I wouldn't go hire a firm to do that. I don't need internal audit right now. There's just elements of things like that. But I still want an ERP that I can scale the company on, like NetSuite. I still want a planning system that I feel good about. I still want to have a data lake with really high quality data. So all those things I think are necessary just to run a really good company, which is one of the criteria to be a public company. And I would say this, CJ, is the other thing is, I don't know, we were talking about this before we started, both having been through exits. Running a good company is also criteria to having an exit at all. And so I think you're doing all those things as a CFO. And if you're not, just because you don't think you're going public, I think you're making a mistake.
Yeah. And whether you're going to go public or not, like if you take money from venture capitalists or a private equity fund, you're technically always up for sale, right? Like
that's right.
And that's why you have to keep the org exit ready. And part of the test isn't just like, what was your revenue number? It's like, is this artisanal where I was joking like 3 guys in a hatchet trying to pull it together in the back room? Or like, does it show some level of maturity that like you have the data when you need it?
That's right. That's right. And, you have the data, you have your finger on the pulse on what's going on in the business. And your business has still got to be, just like it is when it's public, it has to be predictable because investors are either investors, acquirers, that's part of their capital going into that.
Right, right. And at the same time, we're seeing this boom in private credit, especially in the mid-market. When you look back to your earlier CFO roles, Chad, how has the role of credit evolved? What new tools do the finance leaders have access to that they maybe didn't 5 or 10 years ago?
I mean, I think there's a couple things. One is I've always used credit. I almost think about it like rainy day money. So I always coach CFOs to put in place a revolving line of credit on your business. Not that you need it, but it gives you flexibility if you decide to do M&A. God forbid you needed the money, you had access to it. It's generally good interest rates. It's tied to your bank and all that. So I've always had that. I think what I'm seeing more companies do, and it's especially companies that want to avoid, so they raise money at a really high valuation and they're trying to bridge their way to some kind of promised land. They don't want to take a down round. So what they'll do is they'll take structured debt or, some type of private capital. And it's got a return that looks lower than equity, which is good, but still much higher than a line of credit or, what you would think about a regular loan. Generally like well north of 10%, probably approaching 20% interest. I think you have to be careful as a company that's putting that in your permanent capital stack. And especially if you're not, a lot of companies got break even or they're managing very tightly to stay break even, and that's fine. I certainly wouldn't touch private capital if I was burning money. Like private, not private capital, but private structured capital.
Yeah, that's playing with fire.
Yeah, that's right.
How do you think about the role though of traditional banks? Like you could go to JP Morgan, but now you could go to like a Hercules as a fund. I mean, after the SVB crash, there's been like this diaspora of all different traditional venture debt players. I work with the people over at MUFG a lot. It just seems like they're all different flavors now.
There are. I mean, I think I've always been a fan of, I think of your banking relationship as like 3 big reasons why you pick your bank. One is, what's the banking structure? Meaning like, can you get decent interest on your money? Can you put your international capital in their bank accounts? Or are you having to set up a partner network? That's one. I think the infrastructure, the technology tools of the bank, is it a good platform for your finance and accounting team to work in? And then I think the third one is the flavor of like the debt facilities that they have, because I have personally found that the best terms I can get across those are when I bring them all together. If I go try to piecemeal each one, you just don't get it. Hercules is specifically in the last category of the debt category. And the guys at Hercules are great, but that tends to be money that's a much higher interest rate that's meant to bridge you towards something.
And just to put a bow and a ribbon on that, you're saying that if you work with 1 or 2 primary partners, it's better to almost aggregate all the resources together. You get better rates that way?
That's what I've found personally. I think as a software company, let's just say you're running a break-even business, but you're investing in growth and you're being very intentional on capital deployment. Well, if a bank looks at that business, I think that they may say, well, gosh, I'm used to investing in 40% EBITDA companies or things like that. And so I think their understanding of your business, them having visibility to your cash, them getting to know the CFO and the finance team, all those are important criteria to have successful banking relationship.
And you're seeing all these different fintech players pop up, many of whom like the UI, UX, the experience, being able to talk to someone when you actually need to. It's amazing compared to like working the chat bot on Bank of America or something.
That's right.
No shade at them.
That's right.
But at the same time, like it is a different ballgame when there are banks who aren't actually banks and you're really working with a partner bank.
That's right. And especially as you're scaling and you are thinking about having global operations, like that banking network becomes, early in my career, I was with a smaller bank, not a regional bank, but a smaller one. And when we had money in Europe, we had to set up a partner bank.
Oh yeah.
And it was just really painful. And so personally for me, one of my criteria is, can I bank with somebody who has branches in most of the locations where I'm going to put money? And I mean, that starts to eliminate a lot of banks, but there's still 5 or 10 that you could find that'll fit that criteria for sure.
Okay, random question. What's the most painful country you've ever had to set up a bank account in?
It was either India or Singapore.
I was going to say Singapore.
Yeah.
Took me like over 6 months to get done.
Actually, in Singapore, yeah, it was Singapore or, the other one was Poland.
Poland. Did you need a wet ink signature or like someone to go into like the consulate?
I feel like I had to bring my firstborn onto the calls to get everything done, basically. But yes, you needed a lot to get that done.
That's an if you know, you know.
Yeah.
I want to transition to talk about pricing a little bit because you've worked at companies with all kinds of monetization models. So correct me if I'm wrong, but SalesLoft, they had a seat-based pricing model. G2 had a mix of subscription and advertising. And now you're at FullStory where it's a commitment-based model. How have you seen these pricing models, develop over your CFO career?
That's a good question. I think seat-based, there's been so many articles written on this in the high times. In the window from, call it 2017 until 2022, seat-based was like the dream because especially on the way up, you're just getting so many upgrades, expansions, people were hiring. So you got all this natural growth. And when the music stopped in 2023, it was brutal. So you had companies that were seat-based models that had NDR, net dollar retention rates of the 140s that would drop below 100 just like that because of the seat-based
below
pricing.
100. Oh, I gotta drop my stomach from that.
I know, but it happened to so many companies. What I've found to be most effective and why I appreciate how FullStory set up, ours is tied to sessions, right? And that's really tied to how you're going to use and engage the product. And it gives a really clear articulation of not only how we define success, meaning like you want to put as many sessions through the system as you deem necessary to get what you need out of the product. And it helps us to know how we're going to drive usage for you. And then I think what we're starting to see at FullStory over time is sessions is the core pricing metric, but there are other ways like we're starting to explore how do we activate the data. So, one of the great use cases for FullStory is we aggregate a customer experience on your website. Now they're having an issue, they want to go to support. Imagine if we could provide that session summary to the support agent immediately, or better yet, provide that session summary to an AI agent who could probably answer 70% of the questions that are coming through. And so we're starting to explore all those types of things. And I think it all comes back to, is the pricing metric tied to the core way, one, how the customer values your product? And is it something that's not disputable? I'm actually curious, we can talk about it, but there have been a lot of people that have done podcasts on what they call outcome-based pricing. I think you need to always focus on customer outcomes, but trying to tell somebody you're going to charge them X for an outcome, you could debate the outcome. It just gets very difficult to do that.
Yeah, I actually have a hard time with outcome-based pricing, and I think it depends on what you link the value metric to, because like it can feel like you're penalizing someone for like the throughput, and then it becomes a toll. And anytime like you're called a toll or a fee, like you've lost the room, like you never want to be called that.
You got it.
But what I wrestle with is like, I'm purchasing the product to do that exact thing, but I also don't like if I feel like I'm overusing or being penalized.
That's right. You want to feel like you're buying a product, you're using it, and you're getting the value you want to achieve out of it. And at every place I've been, we've constantly looked at, are we using the right metrics? And I think at SalesLoft, the seat-based model at the time was probably the best one because it was the easiest. But I think over time, that's all evolving.
I think you have to link it to almost like a derivative metric of your success metric. Like you're punching somebody in the nose if it's linked like directly to revenue or something.
Right.
But you have to be a little bit more nuanced about it.
That's right. And you have to have a clear and simple way to measure the outcome.
Yes.
Because, let's use the SalesLoft example. If SalesLoft was tied to revenue, it's like, okay, well, we have to agree on, was it SalesLoft that drove the revenue? Was it not?
Oh, the attribution? That's a nightmare.
The attribution, it just comes. And so at that point, you're getting so complicated. Was it really worth doing that. The company that's been the most interesting to watch, I was always fascinated by Snowflake and how they did it.
Yeah.
The way I understand their model, you're committing, so there's a minimum commitment you're signing up for, so that's something that's bookable for them. But they structure their entire business. I think we've learned a lot of this at FullStory as well. And it's in that in the book Amp It Up that Frank Slootman talks about. They structured their entire business to drive usage of their product. They were comping people on that. They were motivating people by doing that. And they had playbooks that they ran. So, you would land Snowflake for one use case, and they would quickly come with 10 other ones, which all of those would drive up your usage of the product.
They wanted to have every department using some sort of tool that drove up usage on Snowflake. Amp It Up's a great book. Rise of the Data Cloud was a bit of a snooze fest. I do love what Frank and Mike Scarpelli built over there, like a true juggernaut when you think about like a commitment and a usage-based model. It's pretty much unparalleled when you think about that model.
I mean, I want to say at its peak, I know it's come down some, but I mean, I think Snowflake's net dollar retention was like 170%.
It was 172%, I remember one quarter.
It was close.
Like absolutely bonkers.
Can you imagine starting the year and knowing
That's 72% growth?
By the way, only CFOs would laugh at a joke like that too. But
Yep. You said something about how they incentivize sales reps. So at all those stops, you've been the guy who's signing the checks for the sales reps. In those different models, do you have to think about incentivizing reps differently, or at the end of the day, is it all the same?
No, I think you gotta decide. I always find sales comp plans, there's two big things you gotta look for. One, they gotta be simple. I think people just overcomplicate comp plans. Not only can they not explain it, but trying to explain it to a sales rep who's worried about how they're gonna make money, that's hard. And I think you gotta tie it to what are the strategic things that are important to you as a business. So the example I would give you is the quota itself. Obviously that makes sense. And we can talk about all the math on the quota and getting the sales you want, but it's also the quality of the sales. Am I incentivizing my reps to sell multi-year deals? Or alternatively, if that's my base, am I being punitive if they're not doing it? Are they getting cash payment up front? If I've got new products coming out, am I setting a quota for strategic products? I mean, there's so many different levers you've got. And so at any given time, I've tried so many different things based on what was important to the business at the time. And I think even thinking about having quotas where you might have somebody who's responsible for expansion and retention. Is it a blended quota where they have a pool of net dollars they're trying to get, or they have two separate quotas and those are two different ways you can set their comp plans?
Multi-year. Do you think it's more or less important in a usage or commitment-based model compared to seat-based?
I think it's more important because I think in my experience, if you sell a 1-year deal, you are almost reselling it 3 months after you sold it because you're like trying to drive adoption and you're trying to make sure they're using it. And in a multi-year deal, you can really align. We're trying to set a path for you to really get value out of the technology. And I think that it's a good indication from both parties. Normally companies are going to give you a little bit of a discount or something to sign a multi-year deal because they want to invest in the relationship. And by the way, you want the company who is wanting to buy your technology to say, hey, I've gone through this whole RFP process. You're my selection. I want to invest in our relationship. What feels terrible is when you go through the whole process and you win, like, okay, now we're going to do a deal and I just want to sign up for 1 year. And you're like, but wait a minute, like we just went through a 6-month sales cycle.
I thought you liked me.
Yeah, right. Exactly. Like let's establish trust. I'm going to keep investing in the relationship and I want you to invest too, because success of technology, you and I know, is not just the partner you choose. They're going to drive a lot of the value, but you have to be committed as the customer too.
How do you avoid short-termism, like reps chasing expansion instead of landing the right long-term accounts? I know you mentioned before, like a lot of times in a commitment-based model, you do have a rep who's both hunting and farming.
I think it just depends on what are your levers to drive expansion. I would think, as you're rolling out new products, I actually like having reps focusing on, I want to say at FullStory now, we've got of our products, we probably have nearly 20% of our customers that use us for more than one product. And it's grown a ton over the last 3 years. And you and I know the more products you land, the stickier you're going to be. So that's important. I personally, it was probably more at SalesLoft with seat-based where I just found like there was like these easy upgrades, especially in the high times. I think those days are gone.
Yeah.
You even if you're doing expansion, you got to sell value.
I remember I was at a company, I won't say which one, but our VP of sales sold like 3 guys in a garage during these crazy times, a 3-year multi-year contract that ramped to like an obscene number of seats in the 3rd year. He's like, they thought they were going public. They thought we were offering the bill.
And that's what's scary, right? Is like you have to really understand what you're signing up for. I would say a lot of those companies that did those huge ramps, you and I know that customers were coming back and trying to renegotiate those things. So it's got to be a really intentional structure that you put in front of a customer for sure.
Yeah. I have a friend, he owns a company that is in the financial services space, and he signed up for a competitor of Snowflake, and he was completely oversold on how much usage they would use. And he's irate about it. And he's trying to tell them like, you like said you were going to help me forecast this to a certain degree. Like they don't have an in-house FP&A team or BI team to help them there, but they still need the product. And he felt like, I'm paying so much and I'm never going to use it. Like that's also another problem.
Yep. No, you're exactly right.
How do you think about staffing the model? Do reps ramp differently depending on whether they're selling seats, impressions, or usage?
I think it really comes down to two things. One is like, what segment are they selling in? Obviously, enterprise reps are going to ramp slower than SMB reps, just based on the way the deal cycles come in. And that's one. And I think the other one is how complicated is your product? There are just companies where it's like, if it just sells itself, it probably isn't that hard to ramp. I think SalesLoft was probably a mix. I mean, the nice thing was SalesLoft, you were selling software to salespeople, so you were using it as a seller. So I think that helped a lot. I mean, FullStory, and we're lucky we've got some really experienced sellers, but we also, it is a complicated, it's a technical sale. And so it takes some time to get kind of used to that and to understand it. But once you do, you tend to ramp pretty quickly.
It helps when people want the product. My brother's in sales. He just moved over from AWS to Cursor. I'm like, dude, if you don't hit your quota, like something's wrong.
Right. And those are the companies you want to be at, I think, because they like the product sells itself. And I think that comes back to my original comment about FullStory, which was like, what's the innovation roadmap?
Yep.
How are you thinking about that? Because all that helps in the sales in the future.
Yeah. And also if you can give a story of like why it's great for both parties when you're spending money. I was saying to you, when we were using FullStory, the amount of usage kept going up every month, which meant we were committing to more, but it meant people were putting brake pads in their cart, which meant we were making revenue. So like, that's a great thing that you can tell customers.
That's exactly right. Yeah. Look, and again, back to our comment, like you were seeing value because we tied the usage to value. And I think that's important because like you can sell software all day long, but if your customers don't adopt it, you're going to lose them all at the end of the day.
Yeah. And if you look back at like the history of software and how it was priced, they call it shelfware because originally they would mail it to you like in a box and you'd put those boxes on the shelf. But like with the seat-based model, it got more difficult because you couldn't just like walk down the hallway and see like, who is actually using it on their computer or not.
Well, and I think, to that point, that's part of what we built in I talked to you about that internal product that we've got, our workforce product. There's 3 big value drivers for that. The biggest one is workflow optimization, like I was sharing with you. That's the one that people love. Well, what's even crazier is it pays for itself because you can use it to optimize your tech stack. Not only can I understand how many licenses have I deployed, but I can look at usage. And it's not just looking at logins. I can see how long. So like I might have some people that have Salesforce licenses, but maybe they only log in for 3 hours a month or some random weird.
We all have a team that has a Salesforce license and you check it and they've logged in like once in 6 months, but they say they need it.
Right. And so you're like, well, we got to come up with a better way. And so I know for us at FullStory, using our own product, we save 25% of our SaaS spend.
That's a crazy number.
Yeah.
Wow.
Yeah.
That's cool. Chad, you're one of my favorite tech CFOs to talk to, but we touched on it the first time you came on the show. You actually cut your teeth at Home Depot. What's something the retail industry taught you about operational excellence that you've carried with you?
I think, there's a couple things. I think software is cyclical. Retail is very cyclical. And obviously different retailers had different cycles. I was at Home Depot, so I knew what the spring was going to look like. We had summer, you had fall load-in of inventory, what the fall season would look like, what Black Friday would look like. Your understanding of how to prep for those seasons became really important. And I think there's some seasons in software not quite as...
Wait, can you touch on this? I joke on the pod all the time that I'm like such a nerd for like odd seasonality things. Like Home Depot spring, was that a peak time or a trough time?
Peak. Yeah, think about it. That's when people are buying all their mulch and all their lawnmowers and their grills and their outside garden. You live in Connecticut. When it starts to warm up, go to your Home Depot and go look at the outside garden center. And it's like, it's a zoo.
I bought a power washer there last week. I took my 3-year-old and for 3 hours, I power washed everything I could find around the house.
That's right. And then I think so different departments are different. You have different seasonalities. I mean, there's some like lumber that run most of the year, but appliances tend to be more promotion based. So like Black Friday is a massive tailwind for appliances. Home Depot got into decorations, like Halloween and Christmas became big. So like the seasonality of the business, ACs and fans, obviously before the summer. So based on what you were selling, you would see these tailwinds. And I think what I learned in retail was your margin of error was much smaller. I think about when I was in FP&A and I was doing corporate FP&A at Home Depot during 2009 and 2010. So it was like right as we were coming out of the Great Recession, the housing market had been clobbered and it was kind of starting to tail up, but it was rocky. And, you and I would talk about, a bookings forecast changed by a little bit or $1 million or something. That's a big deal. I got to deal with it. I mean, I was dealing with sales forecasts that could swing by a couple $100 million in a couple weeks, because like you would see a trend build and you'd say, well, wait a minute, like what's going on? And then you have to, as finance, I think this is what I learned at retail too, was you had seasonality, margins of error were much tighter. And then it was our responsibility in finance to get ahead of the problem and say, okay, if sales are going to move by X, how am I controlling my store payroll? What am I doing in supply chain to make sure that I can still deliver on profitability? Because Home Depot was a public company. And so we may have short sales, but we couldn't miss earnings.
That's crazy. Retail is so much less forgiving than tech. Sometimes I'm like, I've been spoiled.
You have been spoiled, CJ. I would tell you. But it's a great, I think all kidding aside, I think there are so many lessons that I learned. I think about make the news, not report it. I think about, your ability to be a true business partner. I think about investing in data and systems, and all of those lessons I learned at Home Depot. And I've been gone from Home Depot for 13 years now, but was lucky to have a lot of mentors there that taught me those things.
I feel like some of the best finance leaders started out forecasting things in the real world. Like we spoke with Razak Jallo, who's at Flowcast now. They don't make anything you can touch, but like he was at Apple for a while. He was in charge of like how many cell phones are going to hit Sprint this month. Like if you have to get that right, that's like a whole degree of difficulty, because like you're disintermediated throughout the supply chain. Like that's a lot harder to forecast in a lot of ways.
Yeah. Yeah. I mean, we had to forecast. Yeah. I remember I was talking to somebody the other day. We were forecasting Home Depot's medical costs for the company, self-insured, all the crazy accruals, all that stuff. And I feel like you needed a PhD just to understand the model. But you're right. And I think that, again, if you could nail those forecasts, you really could mold that business. The thing about software that I do love is if you understand the operating metrics, it feels a lot more like it's a play on a football field that you feel like you could start to see take shape. Because revenue's lagging, profitability, there's all these lagging indicators. And so if you're really good at digging into the leading indicators, you can really push on the lagging indicators really well.
That's a cool image. Yeah. Chad, I want to take you into what we call the long ass lightning round. So you've been on the pod before, so I switched up a couple of these questions if you'll humor me. But what's a piece of counterintuitive advice that you've received that actually made you better at your job?
I love that question. I have this phrase I use, feelings versus facts or facts versus feelings. As a finance leader, people just assume that every decision you're making is rooted in facts. Of course, most of them are going to be, but you have to learn when to trust your intuition and make risk-based decisions, but where you don't have all the information. And you have to do that because you'll slow the business down if you don't. And the reason I say feelings versus facts or facts versus feelings, when you get into a debate with somebody, people generally talk in the declarative, like, oh, the product's not working, or we had a bad month. And you're like, okay, well, is that a feeling or a fact? And it's okay if it's a feeling, by the way, you're entitled to have a feeling, but just caveat it, say like, hey, this is a feeling, not a fact. I don't have data to support. This is what I think is happening. Then you go figure it out. And this is actually, I think, really important as a CFO, your ability to manage the temperature in the room. People get animated and exciting about something and like, okay, guys, let's use facts to talk about this. Like, let's take all emotion and set it aside. And so what I've learned and the advice I got, and I say it's counterintuitive because I think people would just assume that every decision is rooted in, the most minute detail. And that's just not realistic in the real world, especially in high growth tech. Over the years, your intuition gets better. I tell people all the time, many of the decisions I make now are because I screwed something up in the past of my career. And so I know not to do that again. And, you get the benefit over, to date myself, but over doing this over 22 years, you kind of have pattern recognition at this point.
I didn't have this one on the list, but do you think you trust your gut instinct a lot more than you used to at this point?
Yeah, I do. I do. I think I've learned now to trust my gut, but then having the systems and the people that and I'm lucky I have people that have worked with me over multiple places at this point. They know when I have a gut feel like, hey, let me get data and facts to either validate or invalidate, because some of my gut's not always right. But a lot of times, like, it doesn't sound right. And in generally, it's like, it gives us a path to go down and dig deeper into something like, yeah, we got to fix that.
Trust, but verify.
Trust, but verify. That's right. Great term to use at work, but at home with my wife and my 2 daughters, I can't use trust, but verify. They get annoyed by that.
Oh man, my 2 daughters, they beat me up every day whenever I question them on anything.
Yep, that's right. And now my oldest, she's getting ready to go to high school. I've heard her use with a friend. She's like, is that a feeling or a fact?
No way. It rippled throughout the household, not just the finance department.
I'm glad I could help in that way too, right?
More of a technical question. It sounds like you're drinking your own champagne there, but can you walk me through your software stack? What tools does your team use to get the job done?
We are, set FullStory. Obviously, we use FullStory. Let's set that aside. Finance specific. We're a NetSuite shop, so that's our ERP. We actually are in the process of implementing a new planning system. We're putting in Pigment, which I'm super excited about. I followed that company for a long time, and my team's been really pleased with the implementation. We have Carta, we use Stripe, kind of all of your typical. And then on the procurement side, we use Zip.
Nice. Their name's been coming up.
Zip, this is my I put Zip in at G2. It was incredible for us. FullStory was one of the earliest customers of Zip. And it's such an incredible workflow. It's funny, as a CFO, and you probably feel this too, I don't know that I've ever walked into a company where people like the procurement process. They hate it, right? They just want to buy shit. They think everybody's blocking them. And 9 times out of 10, the process is managed via email, Slack, whatever. And the nice thing about Zip is it pulls all of those interactions into a workflow, into a system. And so I found that to be really, really helpful. The other pieces on our tech stack, we're a Google shop. So we use BigQuery as our data lake. We use Looker as our BI tool. And we've invested pretty heavily in reporting and analytics. And I think, back to, I think I'd shared with you, the fidelity and quality of the data that I can see now at FullStory is further ahead of where I was at SalesLoft for sure.
I was joking with a CFO earlier today that we have so much data now that, like, in order to truly show that you understand something, you have to create like a 1-page plan, like a plan on a page, just to be like, okay, I get it. I can make the complex simple again.
Yes. And by the way, I was talking to somebody the other day. Human nature is to make things complicated. It is by default. And it's like your job as the CFO is simple, 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 simple. Like, you should just be banging on simplicity, because you can't scale on complicated. It's impossible.
You mentioned that you've been doing this for over 22 years now. Where I am at right now, there's like this funny overlap in life where the time you feel like you have to sprint professionally is also when your kids are the youngest. Any advice for type A parents trying to navigate that tension?
My parents got divorced when I was 4. And for me personally, being a good dad was like a non-negotiable for me. And so what that meant was always carving out time for what was important. A lot of times that's the dinners and the things like that, to get to hear about their days and stuff. As they've gotten older, it's if I'm in town, and part of the reason I came back to work at an Atlanta-based tech company is my oldest daughter's got 4 more years. I want to be here working. If she's got a game, she plays volleyball, I'm going to be at the game. And if the game's at 5:00, I'm going to be at the game. And that means I'm putting blocks around my calendar to make sure that I'm there. And that's sacred time for me. I will get on the phone later. I will do what I need to do. And prioritizing family and making that known that that's important. It's just a value I won't compromise on. And so I've been fortunate to work with founders who value the same things. Kyle Porter was a family man and understood it at SalesLoft. Scott Voigt, same at FullStory. Godard at G2. They all supported that and believed in the same thing. It was important to them too. So prioritizing it and making it a non-negotiable. And then I think holding yourself accountable. It's easy to be like, I just won't make the game. I'll do this thing. Well, you know what? Whatever task you were going to work on, it's going to be there the next day, but the games aren't always going to be there. I know that sounds a bit dramatic, but it's true. And so I feel really lucky that I probably learned that lesson early enough in my life that I've been able to prioritize it. But you're right. I mean, you got to do it. And it's hard. Look, that doesn't mean you don't work hard. We all work late nights. We all come back after dinner, crank, do whatever. That's okay. Like, there are times. And obviously when you're going through an exit or you got something big going on at work, you work a lot. But just, making sure you prioritize the time for family, it becomes so important.
Yeah, when we were selling Parts Tech, I had like no balance at all. My wife was like, I couldn't even count on you to unload the dishwasher after it was done. And I had to step back and be like, dude, you gotta slow down a bit and bring it back to like what's important. And I was like, okay, that was a chapter in life, but now I got to get back on track.
You got it. And look, when we sold SalesLoft to Vista, it was a 2-month period that was insane. And I give my wife a lot of credit. She was like, go do your thing. I know you're busy. It'll all be here when you get back. The second you're done with it, you got to shut it off. Because it's hard, right? You just feel like you're going, and then you accomplish the thing. And then you're like, it's really important. It makes working hard that much more worth it when you can share with your family.
It really does. And I think like the higher up you get, it's a great example to set, like to tell your team, like, I'm going to my daughter's volleyball game tonight because A, it shows that you're human and people like that. And B, it shows them that that's okay. And it's a value that like they should support as well. I think a lot of leaders will almost like sneak off to go do something, which is like cool that they're like not doing work at that time, doing something personal, but I look at it like it's a positive advertisement to the rest of the group on what's really important.
Yeah, you got it. And you got to model it, and you got to make sure, that you're showing your support for other people when they do it. And, like, look, there are times like you and I know I try not to bother people on the weekends. Every once in a while I have to. When I make that call or send that text, I would say, first of all, I want to apologize about calling you on a Saturday.
So important.
Just acknowledging that I know that it's not normal makes someone like, got it, versus like, is this the new thing? Is this the new? And I would say a lot of those traits I modeled by watching people not do that for me in my career. And so I wanted to make it a priority.
Chad, this has been an absolute blast to catch up. Thanks for all the insight, personal and professional here.
Yeah, man, I love it. I love what you're doing on the podcast, and I look forward to continuing to follow you and join again at some point.
Thank you, sir. Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds, and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.